Yeah, good evening, guys. Ken at Tortoise Capital. This is the Foundations course check-in for August 3rd, 2023. We got a full load of questions, so let me just plow right into it. The first one, Damien asks, biggest challenge is dealing with a big R loss. Need to find a way to reduce them to maximum 1 R loss. Absolutely agree. The standard way to look at system problems are these. There's only two kinds of problems. There are skill problems in which the answer is education, training, and work. And then there is will problem, and then it's usually emotional state control and true intentions. That's all it ever is. So I'm going to address the skill problem first. I don't know what leads to the big R losses, so I don't know which of these problems there are. But if it's a skill problem, it would probably come down into one of these things. You've got a hardware problem where the infrastructure that you have is not capable of keeping up with the decision-making actions and implementation required from your system. So your system software ouch, or your decision making is making a decision, and that's translating to some hardware, and then the hardware is too slow or incapable of executing the decision into actions in time. If that's the case, replace the hardware. If that's not the case, maybe it's the software. Maybe the decision cycle that I am taking is too slow to account for a rapidly changing market that then moves into action. So it takes me too long to detect a critical state. And by the time I detect it, the window to operate is gone and it's already moved out before I could recognize it. In which case, we need faster software, simpler systems, earlier alerts, or a different time frame. It may be that there's a problem with the trade frame. For example, if I am using an intraday system and I'm placing trades here at the end with an MMRB that is appropriate for that time frame, and then I'm trying to hold that same very tight risk box through a gap into tomorrow's day trade, and the characteristics of the gap are much wider and larger than my tiny little risk box, then what I have is a framing problem, that I'm using an inappropriate frame for the circumstances I find myself in. So frames that work intraday on certain time periods don't work when you add a particular gap, and that could lead to an R. It could also be that the frame is too tight, that there's not enough, if that's the idea of the trade, and I don't have a realistic buffer of safety around it, it could be that I'm trying to overly fine tune, over engineer a solution that is being overcome by not errors in this system, but just uh, environmental noise, that the market itself is noisy. And when I get my signal that the market noise is coming in and making me, so I've got to do is I have to account for system noise or environmental noise by having an extra buffer around that. Now, here's an example. If I have a PSAR flip as the basis of my hypothesis, and I have enough time for that trade to unfold, and I think that it can go up here to my target, and I have this much of a risk box, and I know that a violation of that level is my exit signal. If it turns out that there is enough environmental noise that by the time price comes down and hits my exit signal, that I get slippage and delay and spread, like those things are reliably saying that my fill is typically down here. If I set that equal to 1.0, but I'm getting fills down here at 1.4, because I'm not accounting for realistic market noise in my operating system, I could be getting routinely an extra zero point 0.4 loss, which is why I say that uh, if that's the case, you will then be tempted to exit somewhere in the middle of this noise at like 0.6, so that either 0.4 slippage allows you to stay underneath 1.0. But that defeats the whole purpose of the trade frame, which says that this space between the PSAR flip is noise, and there are no valid signals with information in there. It's all noise. So a decision to execute here at minus 0.6 to account for that noise is not a good idea. What you should do is set that whole distance to 0.6 and give yourself a cushion of 0.4 to account for the normal slippage, spillage, and the delays. That's what I mean by accounting for environmental noise. Your trade frame has to make sense within the logic of the system, but it must also account for the time of day, environmental noise, and the volatility that happens between the time that you implement a decision until the time that it actually goes into action. There's a certain amount of time that happens, and then price is going to have some kind of volatility between the decision and the action. In other words, there's many a slip twixt the cup and the lip. So you have to account for that by widening your stop to give you a protective buffer to protect that system against normal systemic noise. So one of the things that we try to do when we're designing systems is to try to find environments in which we can reduce noise, either because we're picking a quiet time of day to trade, in which case the size of the moves still have to be large enough, and the environmental noise. What we would love is to have environmental noise down, but trade signal volatility up, so that all the moves can be attributed to the theory of the trade and not to exogenous volatility. So that's simply a matter of figuring out what is the time frame I'm trading, what's the difference between environmental noise and systems noise. So the answer to all of these have to be related to system or strategy specific and the environment they're operating in, and then allowing standard work in order to reduce the losses to within the manageable 1R. It normally means doubling the size of your initial stop. That if I think the market signal to get out is here, that I'm just going to make that a 0.5R for position sizing risk and give myself a 0.5 buffer. And then I'm going to treat that whole range as a 1R loss. And then I have to say, do I still have 2 units of 1R above? In other words, I need a 4-to-1 reward to risk ratio against the execution risk of 0.5. So that's how you handle skill problems. You apply skill. If you have will problems, that's a different story altogether. This has to do not with hardware or software, but with the space between your ears and the connection to your heart and the connection to your gut. Somewhere in there, there is a wedge between decision and action, between information and a decision, and then an implementation of the action. Like if I haven't figured out my information requirements to make that decision, then I'm going to spend a lot of time dicking around inside here trying to gather more information because I don't know what I need. So I freeze under pressure, and then I delay a decision, and that's always bad because it goes against you, and then you feel terrible, and you should. or you shouldn't, depends what you feel, what you feel. But if it goes in your favor, you say, oh, somehow I'm going to create a reason to say that was my trader intuition being excellent to know that I should delay and get more information. So that's false. So do I have enough information to make the decision? How fast can I make the decision given the right amount of information? How fast can I put it into action? Now, after I make a decision, so I can look at the amount of the amount and type of information I need. I can take a look at my way of processing it into making the decision, and then I can determine how fast can I put it into action. There is usually a wedge of willpower between the act of making a decision and the act of putting it into action. So we got to know, is there a wedge that is causing you to not put that decision into action? That normally happens. You're making a decision with your head, but the real decision to act is either in your heart or in your gut. So you better figure out, where is the decider? It's usually here in your lizard brain, in your gut. So if that is freezing, if that is a fight or flight, and we can't resolve what to do, that normally leads to freezing, which means no decision, which means you get to eat the entire loss. So we've got to learn how to trade at a level of risk where we can put the risk intention of the gut into the trade frame. So that's accounted for. It doesn't have extra reasons at the moment of decision to intervene. It normally intervenes when it knows or it feels that you haven't done a professional job on skill, or that you haven't done enough prep work and get enough repetitions to provide evidence that we know what we're doing. And to get a lot of reps on a single system, that means your position sizing and risk per trade has to go down so that you can be calm enough to gather the information to provide the evidence to tell the gut to just calm down. We've got data and you've done your job by informing our framing. It can be that there are other things besides the trade that are affecting your emotional state. Like if this is my trader's mind over here, and I've done all the work and I'm making my decisions, but I got other things going on in my life, and I don't have a wall of separation between me trading and me living my life, like the phone is ringing, or I got to respond to emergencies, or I haven't offloaded work and people are coming in and bothering me, or my environment is too noisy and things happen over here and it distracts me and creates emotional distress or whatever, or my fitness is not good, or my diet and food is not good, and my exercise. So all these exogenous things can be affecting the physical and mental plant of the trader to get in the way. So maybe it's that. Maybe it's the time of the day that your trade frame is happening over here and it's working successfully, and now it has moved past the region of fit and you're still letting it trade because the emotions that you feel about this excellent trade are causing you not to follow the rules because you have fear or greed. So it could be just the time of the day and could be emotions. It could be that you don't have alerts in enough time to allow you to go from information to decision to action, and to that when the information comes in and causes a decision to be made, if you know that that generates emotions, you need time to process the emotions into a steady state, to get back to the zero state, to make the decision, and then get through the wall to overcome the hurdle to action. So this all takes time. So you have to bake the time into the cake so that you can handle the emotions professionally. Because if you don't handle them professionally, you'll be rushed into making a decision, and that will unsettle the gut brain because you're not giving it the respect it deserves. So you've got to figure that out. Is it fear of missing out? Is it the size of position that you're trading is causing emotionality? Is it your intention? Is it your genuine intention to win? Are you in it to win it, or are you in it to lose? If your intention is to lose, then all of the will problems are going to have to work harder to overcome skill so that you can still lose with the winning system. So I want to know, you want to know, what's your real intention? Why? Why is that your intention? And how do you know that that's your intention? Well, that better be connected to your purpose and your mission and your identity. If you say that your purpose, mission, and identity are to win because of all the rational reasons, but you genuinely have an untreated condition where your real deeper intention is to lose, then all of the words that describes why you want to win are not dealing with the central issue of why you want to lose. And that needs psychological and emotional state treatment. So what is your intention? If your intention is genuinely to win, then your habits, mindset, attitude, and behaviors must be professional so that you can turn will problems, solve it by becoming professional, and then treating skill problems in a professional manner. Any other intention is going to fail in the market because the market feeds professionals with everybody else. That's all it does, is to separate professionals from everybody else. Doesn't care who you are if you're not professional. There are professional, and then there is not professional. If you're in this camp, it doesn't matter what flavor or why. If you go into the market, you are there to feed professionals. Their job is to eat you. And any other mindset in your mind is going to keep you in the non-professional area. So figure out what the issue is and fix it. Don't trade at higher than pilot and prototyping or for training purposes until you figure out what actually it is. But you cannot trade at production level until you solve this problem, if that's the problem. If it's this problem, then you just got to ramp down your position size risk per trade until you develop the skills to overcome the particular technical problem. So that's that. Next one, Hamad asks, or Hamad states, hey, I have been trading the 3-minute time frames for quite a while. I'm considering switching to the 10-minute charts next week for the following reasons. He gets caught in the chop. No, he trades inside the river, inside the dragon. So take responsibility that you're making decisions to trade very close to the center line of the dragon, and your stops are so small that you're trading inside. You're choosing to trade inside the dragon on 3 minutes because of fear of missing out. Okay? 10 minutes charts don't seem as choppy, meaning that the moves are smoother and wider. Yeah, but the time segments are slower. And that's part, so it does have a smoother characteristic. But the stops are going to be wider and the moves are not going to be as big with respect to the risk. But that may be what you need in order to stop making decisions to trade inside the chop. Higher quality signals on higher time frames, I agree. You can still capture the majority of moves. You can capture major intraday moves. I tend to agree. You want to be a swing trader as your account grows. I especially agree. Could this be a stepping stone? Yes, it could be, and it should be. Yeah, 3-minute charts will burn you out. And you're trading the full session. Is that a best decision on 3 minutes? No. And the 3 minutes feels like a lot of work. Yes, it is, because you have, what is it, 6.5 hours times 23-minute bars. So you have 150 data points to contend with. And that's a decision. That's 150 decision cycles times every symbol. And if you're trading 10 symbols, that's 1,500 decisions. And now the efficiency and the effectiveness and the cost of decision making times 1,500. So if you go to 10-minute, that gets reduced to 120 compared, which is a reduction of 92%. So you're making 92% fewer decisions. That's good for the team. One of the things that you got to decide on would be that if I want to discount the gap, in the first, if I use 3-minute bars and I'm using the 10 period dragon, at the 30-minute mark, when the initial volatility of the first 30 minutes is over, I'm using all of today's data in the construction of the dragon and the PSAR flips and all that. So I'm using current data. If you're going to wait 10 minutes and you still want all of today's data, then I got to wait 30 times 10-minute bars. Oh, correction. If I'm doing 1 minute, I get all the information in 30 minutes. And if I'm using 3 minutes, I'm using the last hour of the previous day. If I'm using 10-minute bars, I probably have to wait a little bit longer. You don't have to wait the full 300 minutes, because then you'd be out here before you have enough 10-minute bars to make decisions only on today's date. But recognize that you're going to get a significant change in the construction of the charts, because it's not until after lunch that it's only today's data that's constructing the Z3 lines and all that jazz. So you got to account for that. Still struggling to find the movers. This gives you 3 times as much time to find the movers, or reduce the number of things that you're looking at. Say, I'm only trying to find the movers inside here. And then you got to decide, if the target set that I have no movers, then I'm not trading. What you're doing, I think, might be, check yourself, is if I don't find movers in my initial set, I'm looking everywhere and everywhere, scrambling because of a desire to trade, and I'm not prepared on these. And then when the market starts moving, like the market's quiet, so nothing is moving in my data set, so I look elsewhere, and then I start taking positions, and then the market starts moving. Now suddenly everything's moving, and now I get too many movers. So take a look at the number of things that are inside your prep list and make a decision not to trade them if they're not moving. Wait for them to move. Now, the good news is that if you widen your time frame to 10 minutes, you can actually have more symbols prepared. Like, I can manage 30 symbols on 30-minute bars, but I can only manage about anymore 3 symbols on 3-minute charts, just because of the cycle time and the cost of making routine decisions. It's a span of control. So you got to contend with that. You still must be concerned about the first and the last 30 minutes of the day. And you're going to still be, I think, restricted to these time windows: the 2 hours in the morning, the reduced volatility of the lunch of about 90 minutes, and then a 2-hour segment in the afternoon. Now, when you look at my way of fractals framing, you notice that I make most of my money on this time frame. And I use that to inform decisions about, am I going to hold it overnight or not? And I'm concerned about, do I hold it overnight and what's the gap and how much money have I made on this one to justify taking the extra risk of the gap? I still got to reduce position size, but I also know that's something that I cannot change. Some of these go on to be very good one day or daily bars swings. Some of those become 3 days. Some of those become 9 days. Also, some of the 9 day setups become 3 day refinements, become 1 day refinements, become 30 minutes. Or more likely, a 9 day chart alert becomes a 3 day tactical, and then I bring that into the 30 minute. And then if it's a sniper trade of the day, it becomes a 3 minute. So I just work on those time frames because there's a factor of 10 between the 3 minute and the 30, and that's a significant enough difference that it's two really distinct populations. There's a bunch of fast, young, aggressive day traders monkeying around in here, and it has volatility characteristics of a certain kind. And then over here, there is slow, fat, dumb swing traders like me who are operating on end of day data. So the 30 minute allows me to steal a march on them, to front run them, because I'm getting a lot more data points. I'm getting 2 data points, or I'm getting 1 data point per 30-minute segment. And now I've seen 10 data points before I make the decision on whether or not to hold it overnight. I have this much information, and I had a chance to make some money in there, and I have time, and I can make better decisions about whether or not to hold it overnight to let it grow to become this. And at night, I can study this and decide if it's a candidate to frame to try to get going early after the 30 opening 30 minutes and make that a 30-minute swing trade where I have about 10 decisions decision points intraday before I have to make an overnight decision. So on the 30-minute, I get about 10 decision points on 30 different symbols, which means 10 decisions on 30 symbols is about 300 decisions, which I can make during the course of the day without burning out, because it takes me 2 minutes to make 30 decisions for all those symbols, and then I have 28 minutes to chill out and recover and rest and reset and get back to the zero state and make plans and all that other stuff. But my decision cycle is fast because I have a reduced symbol set. I'm looking at standard patterns. It doesn't change that much in a 30-minute bar, and it's pretty clear. So you're going to experience the same thing when you go from the 3-minute to the 10-minute. I don't know if that's enough time difference to make that much difference. I know that for me, the difference between 30-minute and 3 minutes is plenty, that I'm never confused about what I'm doing. I always know what kind of a trader I am when I'm deciding, am I a 3-minute guy or am I a 30-minute guy on this symbol? And then at the end of the day, and I make a decision to hold overnight, I know if I'm a 30-minute trader or a day trader. I know if I'm ready to make that transition, and that's enough change that I can get rid of 80% of the position. So for me, the difference between 3, 30, and daily is plenty. And it's wide enough that there's absolute clarity in my mind about what kind of trader I want to be. Now, you might be able to do the same thing with a 10-minute, a 2-hour, and a daily. Because remember, from the 10-minute to the 2-hour is times 12, and from the 2-hour to the 1 day is times 4. So for me, going from 3 to 30 is times 10, and from 30 to daily is times 10. There's a certain symmetry in there, but this gives you a 10-minute versus a 2-hour is a thing that you already want to be thinking about for holding overnight risk. So yeah, all of these things are true. You have a good plan. I highlight these things to just remind you that the standard day has really 5 different characteristic time frames in which volatility is really different. And the kinds of patterns and decisions you make in each of those time frames is really different. Don't be lulled into thinking that this is just one standard time frame with normal, but no, the morning volatility is different than the lunchtime volatility, which is different than the afternoon volatility, which are all different than the open and closing volatility. So you still got to contend with those, but I think your plan is sound. You got to decide what you were going to do. You made a commitment earlier about a 4-week study, and maybe we just need to stop that one, capture the data from it. The data that you have probably says, I need to make a corrective action now. I don't need the next 2 weeks to make this as a good decision, which I would concur with. Lou asked, hey, in previous sessions, I mentioned something that when this pattern happened, it should collapse or work right away if it doesn't get out. Could you point me to a video that might speak to that? Or yeah, it's the critical states and compound critical states. Here's the, or this video or last night's discussion. Look, there's 2 kinds of trade patterns that we have. I'm going to cover them when I get over here. But some of them are really associated with, I want to find critical states, and especially radioactive compound critical states, because the difference between the setup and the action is enormous. And there's something exceptional about the difference between A and B. Something happens that makes things just explode beyond all rationality. So if I have a standard behavior, and this is the average behavior, and this whole thing is the normal zone, then I have the abnormal zone when things are either abnormally volatile or abnormally quiet. Now, if I think about patterns where there's no volatility, what I want is things like cows eating grass. I see that price is behaving with normal volatility and has sort of this wandering quality to it that when I put a regression line on it, it just looks like this. And maybe there's some little dips and peaks and valleys, but it kind of looks like that. And so when I draw that strict regression line, I'm betting that the regression line is what's true. And I can just decide, you know what? I'm just going to buy this thing now and quit worrying about it. And I'm going to have a wide enough stop loss that parallels that stays well out of the normal noise of this thing. And I have this very comfortable buffer. I have this very comfortable buffer over here, which is going to keep me in that trade as long as that broad trend is continuing. Long-term buy and hold of relative strength momentum leaders that last weeks, months, quarters, and years. Relative strength plus with a wide stop, and then enough of them inside my herd that I can look at my herd of 30 to 100 symbols and say that at some given moment, these are the ones that are the relative strength winners, and these are the ones that are just getting murdered, and these are the ones that are average. And so I'm just gonna I am just gonna concentrate on these little guys that are inside above average but not super abnormal yet, that I'm watching those as candidates to become the exceptional leaders that are freaking amazing. That's what uh, blended monthly rebalancing and the weekly review of the longer term systems is designed to do. The sorting mechanism just says, look, I just want those things, and I just need to find the demarcation line. And that's what the regression line fractals are doing, and um, um, blended monthly rebalancing are doing. So certain strategies like RLFF, channeling, 551W, triple screen, blended monthly rebalancing, these things are designed to find cows eating grass as they're moving towards market and just lets them be what they're going to be. The absence of volatility, just slow growth. That's the whole thing behind long-term trend following, long-term buy and hold, and asset allocation. And I'm just using a simple sorting strategy to find those four categories. And I want to be in the green ones, and I want to study the white ones so that I can catch them as they become green and stay green. It's a separate strategy to say, hey, let me do something different down here, but I'm not even trying to do anything with that. Those are opportunities that are a different system altogether. So those are strategies that look like cows eating grass. The other thing is, if I'm looking instead for critical state, compound critical states, I'm saying that there is something in this run up to the present which highlights this as an exceptionally different moment in which going forward here, as soon as I get a trigger, so I take the setup plus a trigger, it takes a trigger, and then I can expect things like an ambush, a stampede, a coiled spring under pressure is relieved, then it goes boing, or it's a jack in the box, or some. That's the trigger that suddenly takes this loaded thing and it becomes an avalanche of movement. If that's the case, this thing better happen fast. Why? Because I took a position with a really tight wrist box when that trigger happened, and that thing better just go so that I can get this amazing move. And if it doesn't happen right away, that I can just get out because the expected abnormal behavior did not occur. The dog did not bark. And now suddenly, this hypothesis that I was in a pre-avalanche condition, ready for things to explode, didn't work. I stepped on a landmine, but instead of blowing up, it was a dud. So there's a cost of taking the position and it doesn't explode, and I'm going to take these little fractional losses or -1R losses or whatever. But when they work, it should go. So if things come into the station and now I've set it up and I have a favorable condition for that, and I get my little trigger, it better go, or it's going to be fake one, go two. But if it fakes one and then goes nothing, I'm taking tiny little losses a lot in that space, which means I got to get out. I can't believe that I picked the right direction. I didn't pick the direction. I got a noise that sounded like what could be the beginning of an avalanche or a stampede or something, and it just didn't trigger. The herd did not move. Everything was set up for it to move. They just decided not to wake up. I guess they were just really, really tired. You know, when the herd is asleep, you don't know if they're exhausted or if they're just sleeping lightly, ready to break. I don't know where in their little sleep state they are. Are they extremely exhausted and it takes a lot of movement to trigger them? Or are they very light sleep and the first little whisper of a hint causes them to go? I don't know. Well, if you have these kinds of patterns, the expected time of the trade says, hey, if it takes more than 6 bars or 4 to 6 bars, 5 plus or minus 1, your mileage may vary, then it ain't working. Why? Because you had 30 bars of setup usually to create the statistical anomaly of a compound critical state. So if in 5 bars, in 1/6 or 1/5 of the time or 1/6 of the time, the trigger happened, remember? The trigger happened, so you got in, and if in 5 bars it hasn't done that, then they're not behaving according to the statistical expectation, so get out. Yeah, but what if they start working, then get in? Re-entry is the key to sanity. If the trigger happens again and they start, the trigger is still the trigger. Remember, if there was a range compression, which is a feature of all of these patterns, there is a range compression. And if the little trigger didn't happen and it just came back in and started monkeying around, guess what you have? You have more range compression. So the trigger, maybe with a minor adjustment based on that little false move, maybe it's a little bit different, but it's approximately the same trigger. It's still in a condition of range compression. So when it goes, the same reason that made that a good decision here makes it a good decision there. So I'll just say 5 bars. But that's why I say 5 bars, because that's 1/6 of the 30 bars that it took to set up the statistical condition. Hey, guess what? If you have a normal and then a plus or minus 1 standard deviation, that means 1/3 of the time it's inside here, and 1/6 of the time it's one of these extraneous conditions. So 6 or 5. If it hasn't worked in 5 bars, yeah, it didn't work. Next bar, it could work because the trigger hit. So that's a fuzzy number, but you can work on that. And just remember, I would rather be out wishing I was in than in wishing I was out. So just get out and then re-enter. As long as you don't care about being right, you can be safe and active. Jose asked me this one. This deserves about an hour of an answer, but I'm going to give you the outlines of it right now. Early starter. Okay, so I want to trade the markets between 2 and 4 Eastern because I get off work at 1. So are you tired when you get off of work? Are you in the ideal state of mind to then put in 2 hours of effort, I'll be trading the 5-minute charts. Not unreasonable, because if he's only trading the last 2 hours, I'm going to say, are you really going to trade the last 30 minutes with the crazy volatility here that is different than all of the information that you got from the earlier segments? Are you really prepared to make the change of state of mind from these 90 minutes, which is a continuation of the morning trade, and then they're starting to unwind and position for the overnight, and then absolute madness into the boy? That is a significant emotional event. So are you really going to trade all 4 of those hours? You're going to trade, or 4 30-minute segments, or are you just going to trade 3 here? Can you, by the time you get home at 1, can you be in a zero state with all of your other obligations done by 2? You have 60 minutes to do all your prep and analysis and emotional mind state to be ready to trade for the next 90 minutes, and then whether or not you're going to trade the last 30 minutes. Can you do that? Are you going to scan all 500 stocks in the S&P to find the biggest percentage gap up or down? So what's more important for the movement of predicting movements that are tradable in the last 2 hours? Was it the size of the gap from yesterday's close to today's open? Is it the size of the gap, or from the open, was it the size of the move from the open to open plus 1, 2, 3, 4, 5, 6, 7, 8, 9 30-minute segments, open plus 4.5 hours? Which one of those is more important about predicting the size of the move that's tradable in the last 2 hours? I would argue that the reason we pay attention to the gap is because we want to be ready for the open, for the potential of the biggest movers early. But you're already seeing 2/3 of the day. Maybe what you want to find is the biggest change percentage from the open or from yesterday's close. I think from the open. Which one has actually already made the big move? Is it likely that something that had a huge gap then got very, very quiet and then was going to wait until suddenly the last 2 hours to make the huge move that the big gap predicts? Or is it more likely that something that had a big gap but then didn't move just was a failure to move, and that the last 2 hours are just going to be normal? I think that's more probable, that what it did from open to time now, time zero, is a better predictor than the size of the gap. Just what's the plus or minus percent change so far? That's how I find them intraday all day, is I take my stack and I look at percent change from yesterday's close. So that includes the gap plus the price. I just look at the current price versus yesterday's close, because the current price is then going to end up becoming the close, and then the day over day difference is going to be from close to close. So my hypothesis is that the difference between the current price and yesterday's close is the best predictor of what was going to be the biggest mover of the day, and which is going to attract people's attention for the swing trade. So that's what I would probably look at. S&P 500 that has a volume of over 200. So what you're really not going to do is scan the S&P 500 according to that plan, but you're going to look at things that are in the S&P 500 plus greater than 2 million shares traded, Y, and price above 20. Probably because of liquidity What if something was not in the S&P 500 but had 2 million shares traded and was more than 20? Are you going to rule those things out, or are you just going to focus on the biggest, fattest, most likely follow throughers? Okay. I will risk $10 per trade with the ultimate goal of keeping my stop loss less than $10. Okay, well, there's things in the S&P 500 that are have a share price of $10. There's things in the S&P 500 that have a share price of $1,000. How meaningful is it to say I want to risk $10 per trade on something that costs $10 per share versus $1,000 per share? A movement of, if and I want my stop loss not greater than $10. So there's a difference between stock price, stop loss, volatility, and hypothesis. The difference between risk per trade and the stop loss side. What I'm going to teach you in foundations, like on the PSAR flip or on the RLFF, which looks at a difference between the current price as measured by the RL10 with a risk box to the bottom of the RL10 and expressing that as a return to fair value that's greater than 4-to-1, that's a hypothesis that this trade is in an opportunity state, which says there's a reason to believe that the anomaly of the sell-off is going to get corrected back to the long-term fair value, and that there's a 4-to-1 imbalance between reward and risk, which justifies taking the risk, and that I've seen enough favorable price action to suggest that that might actually be the bottom and that the reversion to the long-term fair value is occurring. If that's the hypothesis of the trade, I don't care how far this is from price to the failure price. Like, what if that was $20? Well, then this would have to be $80. As long as that ratio is 4-to-1, I don't mind having a $20 execution stop. So why does what's magic about a $10 execution stop? What matters is that the execution stop should reflect that the hypothesis of the trade has failed, and now you have evidence to believe that the upward move is not occurring. That's what we want in the execution stop. And I want a reasonable chance to see both the reward and that the size of that execution stop is manageable. The shorter your time frame, like, oh, by the way, the last 2 hours of the day, and if I'm using a tiny little risk box because this was manageable in here, but I'm expecting greater volatility, that's why I may have to set that equal to 0.6 so that I can have a buffer of 0.4 so that I never take greater than a 1-hour loss. That's fine. So what that means is I have to figure out what size the actual manageable risk box is. That's the MMRB, because I got to be able to see the signal, act on the signal, and still, with slippage, spillage, and the passage of time, not take greater than a 1-hour loss. Now, if that's my minimum manageable risk box, can I still see a reasonable 2 of those inside this 90-minute or hourly move? So that means that I got to pay attention to the low of the day and the high of the day, figure out where price is at this moment, and then from the low of the day, is there still reason to believe from here, if this is my range stat move, and if this is my risk box, I could then say, hey, it could still move back to the high of the day or to the range stat, and then compared to my minimum manageable risk box, I can still see 2 to 1. Okay, then I could take that trade within the expectations of volatility in that last 2 hours of the day. Now, $10 risk per trade has nothing to do, has absolutely nothing to do with the pattern that you are choosing to trade. That the only thing $10 per trade has to do with is what percentage of your portfolio does $10 of risk capital represent. If I'm trading $100,000 in my portfolio, a risk of $10 is 1/100th of a percentage. So I'm not putting the portfolio at risk, because if I take the 1 hour loss, I'm going to lose $10, and that's not going to put the seed capital at risk. I can afford just to let the system be the case. Don't confuse that with the cost of position. The cost of the position is that I've got, if I have to buy 30 shares of $100, I have to buy 300 shares of $100 stock, I got to spend 30K to buy. Can my trading capital buy the position? I'm not risking 30K unless I have a system where I cannot control the losses to 1R. See my earlier discussion. Don't confuse the cost of position with the dollars at risk per trade. Don't confuse the dollars at risk per trade with the size of the stop loss, which is geared towards the hypothesis of the trade that tells me that trade is not working. Hypothesis is over. 3 really important questions. So here's what I'm going to tell you to do. You are nowhere near ready to answer that question correctly for yourself, I think, until you've thought through some of those things. So your other questions were, what are my thoughts on this time frame? That's the hardest time frame you could possibly choose, given that you just worked a full day, 8 hours or 12 hours. You have 60 minutes to come home, decompress, get in the mindset, do all your thinking and all your prep, read the leaves, scan 500 symbols to pick how many are you going to consider with your span of control. 1, 5? It better be just one. Otherwise, you're going to be chasing all of that scramble and not even be focusing on effective performance. What I would tell you when you listen to all the lessons in the foundations is I would say something like, hey, before you make any decision on that, how about listening to the nightly podcast for 30 days? Look at my 3-minute sniper trades of the day, which looks very much like what you're doing here, or the 3-minute, 5-minute Aussie, or the Forex guys. Oh, by the way, Forex is great because now you're not locked into just trading for 2 hours. You got 18 hours to pick and choose. You're not under any time pressure. They have much less bar-to-bar volatility, and the trades unfold at normal times that are not constrained by the absolute madness of the closing 2 hours of the equity markets. That's what I would do. I'd take a strong look at what the guys are doing in the 5-minute Aussie, the 3-minute Aussie. And then you could look at the 3-minute, 5-minute, 10-minute on the Forex instead of trying to fit that in a 90-minute session. But you might take a look at the 3-minute, 5-minute, 10-minute on the stocks and decide if you can execute that. You should also study the Kata 2 challenge that the guys at Able Way Tech are doing. What I told them to do when they were first learning how to trade intraday in those constrained time frames was pick 2 symbols, an aggressive EWZ index and a conservative DIA. Don't scan anything. Become expert in a volatile index that moves all day, and a conservative index that moves all day that can be traded with futures and with intraday movements and in the aftermarket in futures. And you're not constrained the way you are just with equities. And then you can learn how to trade these patterns and find which of these. Is it the SSC, the collapsing dragon, the Z3P, the COTA 2? Which of those is a pattern that you could use on one or the other or both to develop the proficiency over 300 trades in a month to decide which style works for you? And then you could decide if 3-minute, 5-minute, or 10-minute is appropriate. By understanding those, you can defer for a little while answering all the specific questions of the standard trade framing. So instead of trying to frame trades across 100 symbols and choose it, no, just keep it simple with standard patterns. Look at the COTA 2 challenge, look at EWZ and DIA, start practicing those, and practice those all day intraday with bar by bar trading, so that when you finally decide which bar by bar you're going to do, 3, 5, or 10, on which symbol you want to choose, EWZ or DIA, once you get proficient on those, you could begin to think about finding the things that had the biggest percent win or loss from yesterday's price as a way to say, well, that thing is probably going to have one more strong follow through all day. What you're doing there is you're looking for the extra volatility of those symbols instead of the predictable volatility of DIA or EWZ. But you got miles and miles to go on a long journey to answering these questions. And the foundations course over the next 10 weeks is the time to start taking those steps, making tentative plans, and doing like Hamada's doing. Started with a couple symbols, expanded the symbols, looking about changing time frames, adjusting position size, going to a 10-minute chart. He's exploring in a systematic way all the options he has to find out what style works best for him, as opposed for waiting for me to tell you one thing. I haven't seen anything about how you trade yet. So don't hurry that. Just do the bar by bar with forward trading, paper trading, but committing to the process and showing your stats. Now, how do you get the right stats? Get a hold of Griff Cooper to give you the stat sheet in Excel so that you can look at standard patterns expressed in the way they keep score, so you can put our standard statistical treatment on it. You'll see plenty of that over the next 2 weeks. The boys in this room can help you with that too, that are in foundations right now, because they better be doing it too. So that's what I want to say about this. So let me get this publishing process, complete the daily report, and I'll see you guys in about 15 minutes. Good questions, great work. There was a weekend worth of work in that 80 minutes.
Thanks for your wisdom, Ken.
Yeah,
like
so study
always.
these. Okay, got to run.